Hello all, happy Thursday. Welcome to the Life Plan 360 training. We do this every Thursday at noon Eastern, 11 a.m. Central. For those of us who are joining us for the first time, my name is Kendra Rhodes. Just admitting people here. So welcome if this is your first time joining us, and please feel free to jump in and ask questions. We'll get started in just a couple minutes. We'll let people join. Okay, so there's a couple of names that are new, I believe. So if you're new, welcome. If you've been on our trainings before, fabulous, welcome back. Please feel free to let me know if you have questions. And I do try to mind the chat box, but as I really start getting into the live training and I'm doing multiple different things, I have a tendency to neglect the chat box. So if you put a question in there and I'm not answering you, please feel free to just jump in and ask me. Don't feel like your only avenue is the chat box. So yes, there is that. And we're just going to give a couple more minutes to let people join. I always feel like as soon as I start digging in, I get like 4 more people who jump on. So I try to give people a couple minutes to jump on. If you have any particular questions, now is a great time to ask them. Okay. And if nobody has any questions, I can definitely jump into where we left off with different features of the software. If somebody had something in particular that they wanted to see today, I'd be more than happy to talk about that. So feel free to let me know. Okay. So yeah, if anybody is having audio troubles, like because I'm seeing that there are people who are still connecting and have been connecting for a while. You might try jumping out and jumping back in if that fixes it. Sometimes that works. Okay, so for today, there were a couple things that we talked about last week that I kind of want to give you every time. Let me just admit a few people. Okay, there are a couple things that we started talking about last week and the week before that I kind of wanted to just jump into and give a little bit more of an in-depth tutorial on that. So, and all of the everything is really based in the software. The software is where you find the most helpful things. But last week, I believe we were talking about a client family, and we had gotten to the point where we had completed their, oh, sorry, let me admit people. Give me just a second. Okay, so we had gotten to the point where we had finished the stress test and they had decided that they like life insurance. So we need to run illustrations for them. And that is never going to match up perfectly with what we did in step 4. So I'm just going to share my screen real quick. Give me a second. Share screen 3, share. Okay, can everybody see my screen? Yes, no, maybe?
Yeah, we see it.
Okay, good. Okay, so for anybody who is new or may not have been to a training in a while, I very much like active participation. I will ask questions and wait for a response. So, okay, so everybody can see my screen. So this is what we had come up with in step 4. And for anybody who missed our training 2 weeks ago, I just want to do a quick recap. So in step 4, we're ending up with $1.8 million of guaranteed growth. But I want to show you that this is not a ridiculously wealthy family. So this family is making about $140,000 a year. They do own their home. They do have a mortgage. They do have debt. They have cars. They have student loans. And basically what we have done is we've rearranged what they are already doing and just made those dollars work to their benefit. So my personal favorite is Parkinson's law number 2. So I'm going to reiterate that expenses rise to match the available income. So the way we get around that rule is to give those dollars a job. When we pay something off, we have to redirect those dollars or they will disappear, because everybody's heard the phrase idle hands are the devil's playthings. Yes, maybe.
What was that again?
Everybody's heard the phrase idle hands are the devil's playthings.
Oh, yeah, sure.
Yeah. So most of us have heard that phrase at least once. Well, idle money is the same way, that if you leave money alone, it will find something else to do. You need to give it a job. So that's what we're doing right here. And we've built our bank. So then we come to step 4. We prove that it works. And this is the money after they've spent the money to send their kids to college. Which, to recap, we had 2 children going to school, one starting in September, one starting 2 years later. And yes, they didn't think they could retire. And we can guarantee $1.8 million in growth over the next 18-ish years. Okay, great. That is if they do everything as we've shown here. So let's take a look at how that functions. And let me open another tool. Let me admit people as well. Illustration contribution calculator. Okay. Bear with me for just a second. Did it open? There we go. Okay. So as we have decided, our family is saving $52,000. Yes, Sal, we're going to get to that in a second. Sal, I think you were here last week. So in step 5, we let them design their own plan. So we went through all of the attributes that they would want a product to have if they're going to use it as their personal bank. And we went through all of the financial vehicles that are available. And we did talk about real estate, even though it's not listed here, to see which financial vehicles match up with the attributes that they wanted. So when we went through the whole thing, and I'll just unhide some of these for a quick second. You know, they chose to hide all of these things because anything with red in it is not a vehicle that meets their test, and therefore they didn't want to use it. So we'll hide these back out. And the only thing that we are left with in that case is cash value life insurance. So is there a whole life portion to that? Yes. But let me so we have our one-time contribution, and annually we are saving $57,000. So what does that really mean? That means that we're starting our bank with $52,000, and every year we're contributing $57,000. So our one-time contribution does not eclipse our annual contribution. So we don't have the ability in this particular case to pay annually, in which case when you pay annually, the cost of insurance is slightly less. So it's, you build cash value faster. What we're going to go through today is to show how we design a policy, or how to design a plan, and how that works precisely. So as we said, this is Life Plan 360. What that means is that we're covering 360 degrees of their life. In any contingency, this family is protected. So they are protected against living too long, running out of money. They're protected against an unexpected death. They are protected against, life happens. We want them to be prepared for everything. So that's why it's called Life Plan 360. So to do this properly, it needs to be designed properly. So I'm going to pull up a little fun tool that I have, and this is very simply a spreadsheet that does the math for you. So let me see if I can just snap that over there. Awesome. Okay, so this is a 2-person household, right? So we're going to go back to step 3 for a quick second. So person 1 was making, of course it's going to do this to me. Person 1 was making $55,000. Yep. And person 2 is making $95,000. Okay. So we know that this household is making $150,000, and it gives us the percentage of their income. So we're just gonna make that a percent. There we go. So it's basically a 37-63% split, but we're also gonna have the spreadsheet do some math for us so that we don't have to do it longhand. So we said that their annual contribution is 57,552. So I'm just going to round up to 600 just for kicks and giggles. And their one-time contribution is 52,300 equals. Okay. So it gives us our annual contribution for each party. So just based on the numbers, so 37% of this $57,000 is 21,120, and 63% is 36,480. And of the one-time contribution, 37% is 19,200, and 63% is $33,000. So remember, for this client, we said that we are paying monthly. Because we cannot, we don't have the full $57,000 up front to be able to put in. Does that make sense to everybody?
Yep.
Okay. So we're going to come over to foresters, and I'm going to make this a little smaller, make that a little bigger. Okay. Can everybody still see my whole screen?
Yep.
Okay, good. So of course it logged me out. eBiz. Bear with me a second. It's thinking. Oh, did it really? Sorry, give me 1 minute. Bear with me just 1 second. It locked me out. Okay. Continue. Okay, we're here now. So illustrations. I'm sorry, did somebody have a question? Okay. So we can leave it for Colorado right now. When you're doing this for your client, you'll need to know what state they're in and select that. But it doesn't really change the illustration at all. Oh, I've got 2 people in the waiting room. Admit. Okay. Yeah. So we're going to go to the Advantage +2. Okay. So we're always going to go with a medical product because the limits are much higher. So let's say we have a husband and wife for this And I think their birth dates were default scenario. Yeah, 74 and 77. So June 12th, 1974. Awesome. So 6/12/1974. And we're going to say that this person is male, and we're going to say that they are non-tobacco. If they were tobacco, you would just change it in here. Other than that, I always run illustrations as standard. Most people will come in as a standard rating. If they come in as a preferred rating, more is the better. Basically, it just means that they will end up with more cash value over time. But it's always better to under promise and over deliver, because if you can go back to a client and say, so good news, so you're actually coming back with a preferred rating, and what that means is you'll end up with more money over time. Whole lot better conversation than being like, so we overestimated and actually your standard, which means that the cash value will be slightly less. When it's something like, oh, they came back as tobacco and didn't tell you, and yes, I have had that happen with a client, yeah, they're going to end up with less cash value, and you might need to rearrange some of the death benefit between the two partners to achieve the best cash value. But that's not something that you did. That's something that they didn't tell you. So most people are like, well, yeah, you're right. I didn't say, I shouldn't do this. Anywho, moving on. So death benefit and funding. Okay, so what did we say for person one? Our annual contribution is 21,120. So I'm going to grab my calculator. 21,120 divided by 12 is 1,800. So, oh, helps if I put it. So the solve that you want is the FPUA permanent term blend non-mech face solve. And yes, it is a mouthful. It's the fourth one down from the top. So what you really are looking for is the non-mech face solve is what you need to remember. In terms of the term percentage, you can leave it at 75 for right now. I probably will. This ranges depending on the client, what you're trying to achieve, anywhere from 65 to, I usually max out about 80. The highest I really ever go is 85, because that term percentage, that eventually that term rider is going to fall off. So remember how we're trying to protect their whole life in case of an unexpected death, etc. You want to make sure that when that term rider falls off, that they're not losing the vast majority of their coverage. So 75 is where is most clients. But for right now, we'll leave it at 75. So what did I say? 1,800 a month? Perfect. So now we come over to riders. And we're gonna drop this down a little bit. We're gonna call it like 30, I think. So our annual lump sum, remember over here, our one-time contribution is 19,200. Well, actually, where this person is monthly, we're gonna say that it is the 19,177. And that's too many zeros. Okay. For year one. Okay. So that,
Hey, Kendra,
yes.
is your maximum annual payment should be 300,000 or 30,000?
Nope. Thank you for that.
All right, thanks.
Yeah, let me know if I have put in a typo, because yeah, so this number right here only actually matters to underwriting, because that will get added in to the amount of underwriting premium. So for some clients, $100,000 max annual into the PUA is fine. For some clients, based on their income, they're never going to get approved plus all of their death benefit. So just something to keep in mind. So yes, thank you for letting me know that I had a typo, Jose. Okay, so just for kicks and giggles, we're putting all of this in on year one, and we're going to see how that plays out. So, oh, and this person is in their 40s, so we definitely want to make sure that they have a 20-year term on it. Because remember, we're trying to protect their whole life, so that 20-year term is going to have that higher death benefit for 20 years. At which point their kids are likely grown and gone. They're not supporting small children at that point. So with the slightly less death benefit, it's not going to devastate a family. So yes, keeping that 20-year term is always a good thing. Yeah, it's slightly more expensive, which means that the cash value grows just a little bit less quickly. But when we're looking at that whole picture, it's usually beneficial to that family, just to have that peace of mind. So we're going to take a look at the at a glance. Okay. So in year one, we're putting in $35,000, and all subsequent years we're putting in 21,600. So our guaranteed cash value year one is almost $29,000, which is not bad. And in year 10, we have put in
Oh, boy.
21,600. Guys, can you mind your background noise, please? Oh wait, 21,600. So 216 plus 19,200. We put in 235. So we've actually not quite met our 10-year rule. So we're going to play with this a little bit. You want to make sure that on a standard basis, it breaks even at about year 10. If they have no medical problems, clients in their 40s. So what we're going to do is we're going to take this number and divide by 3. 19,200 divided by 3. Enter. So $6,400 a year for the first 3 years. Okay. So at a glance. Okay. So, and what did we say it was that we put in? 21.
You said 235, something like that, but I don't know how do you get that number?
Okay, so basically we're taking 21,600 because that's what we're putting in every year.
21, how many times?
$21,600
How
times
many years?
10
Yeah.
years
Oh, okay.
is 216 plus 19. What do we say? 200, I think. It's 135. Yeah, so question is, why are we not breaking even?
The first 3 years, I can see about the 28,000. How you get the other number?
How are we getting this number?
Yeah, that number is there, but you didn't calculate that number with that calculation?
Actually, we did, because they're putting in 21,600 every single year.
Okay.
Plus 6,400. So 21,600 plus 6,400 is $28,000. Does that make sense?
Okay.
So it's kind of doing some behind the scenes math for us, but we've told it what we're putting in. So the question is, why is it not breaking even? I just want to see something real quick. I put that back to $100,000. Oh, I know why it's not breaking even. Okay. So also, just as a side note, to do the calculation that we just did right here, this spreading this over 3 years, this is utilizing something called the premium deposit fund, which puts all of that money into the premium deposit fund. The client continues to pay monthly, but the policy pays annually. So if we come over to death benefit and funding, it has to be annual to use the premium deposit fund. So what did I say over here? Yeah, so basically we need to come up with another $5,000 for the one-time contribution to be able to match it, which in some cases can be done, in some cases can't be done. But does everybody see how this plays out? If they use the premium deposit fund, they must pay annually. But depending on the family, they could keep some of that out in a separate account. I really don't like to do that because, again, Parkinson's law says that money that exists will be spent if it doesn't have another job. And money that you have available to you will be spent before you even get it. So if it's sitting over in that account over there, 95% of families are just going to spend it and then it won't be there to add. So we're going to see if we can get them to that one-time contribution of $57,000. So we are going over the case study right now. So this is the case study that we've been putting together over the last couple of weeks. So that being said, let's see, what is the at a glance? Oh, if we're changing it to annually, we have to change the payment. So 120 at a glance. Okay, so that's much better because that brings us to where we actually need to be. So that means that we are guaranteed to have at least as much cash value in year 10 as we have put into the account, which means that the death benefit has cost, I can't highlight just one column. The death benefit has cost us nothing. Does that make sense?
Yeah.
Okay. So for anybody that doesn't make sense, please let me know. I'd be happy to explain it. Sometimes people have a difficult time wrapping their head around that we've gotten an amazing benefit that didn't cost us anything. So that being said, we're going to be
Kendra.
yes.
Not to interrupt you, back to that illustration on the last column of that illustration you just shared.
Yep. The
That shows
FPUR,
the FPU.
the catch-up space.
So that's what the FPUA catch-up room is saying. What is that? What is that? So of the $100,000 that it's maximum into the account, because you paid 27 that first year, the difference would be the 7604 and on like that.
Right. But that doesn't mean that that's how much the FPUAR could take, but that doesn't mean that that's how much the policy can take. So we've pretty well maxed out.
Okay.
So let me show you something. So our contracts, okay. Sal, email me offline and we can go from there. So our contract premium year 1 is $27,520. Yes.
Yes.
Okay.
You're talking to me or somebody else?
Anybody can participate. So,
Oh, okay. No. Okay, no, because I asked the question.
Our 7-pay premium is $27,520. So we're pretty much at our 7-pay premium for the first 3 years. So for anybody who's not familiar with the 7-pay rule, the federal government cracked down on insurance policies. I want to say it was 1984. And they basically said that you could not put an infinite amount of money into an insurance policy and have it generate cash value without being taxed. So they instituted this rule that said for a period of 7 years, if you have this much death benefit, or if you have this much cash value, you must have this much death benefit. So there's that ratio that keeps the death benefit higher and the cash value lower, which is why most people will tell you that a whole life policy is very expensive. However, having a paid up additions rider and a term rider, remember, we all know that term life is far less expensive than whole life because of the limited liability issue. So if we have that term rider on the policy, it bumps the death benefit up to cover that 7 years for significantly less than it would cost to have whole life death benefit of that same amount. So it brings our 7-pay premium higher, but our 7-pay premium is the maximum that we can put in any given year without turning the policy into a MEC. And we do not want to turn it into a MEC because that's when it becomes taxable. The government slaps your wrist and says, that's an investment and you owe us tax now. So we don't do that. But by using the PDF, we now have built-in space. So this client in years 4 through 10 can add an extra $6,400 a year into this policy without issue. It will fit. It will pass the 7-pay test. Does that make sense?
Yep.
Okay. So the FPUAR catch-up space is sort of irrelevant, but the FPUAR maximum amount, I'd like to bring your attention to the years between 5 and 6. So it balances itself at year 6. So whatever they have, the average of whatever they have been putting in for the first 5 years into the paid up additions rider becomes the new maximum of how much it will take for years 5 through 10. Does that make sense? Should I say that again?
Yes. tell me.
Okay. So whatever we've been putting into the paid up additions rider for years 1 through 5, they add that up and take the average. So let's say it's $100,000 over 5 years. So $20,000 a year divided by 5 is $20,000. So that would become our new average. In this case, our average is $21,356. So that becomes our new maximum for years 5 through 10. And the illustration is not the contract. If they, in years 4 and 5, if they put in that extra $6,400, their average will be higher. Does that make sense?
That is, you're talking about non-MEC, right?
Non-MEC policy. Yep.
Okay. I got it.
Okay. So that being said, we now have our illustration for person 1. So I want to export this to a CSV. So we're exporting to a CSV. And I'm just going to copy this. Copy. And family illustration. So client 1, pay special values. Okay. So we've added client 1 into our spreadsheet. Now we're gonna come back here, and we said that client 2 was 8.4 of 77. And this person is the wife. So 8.4, 77. Okay. Non-tobacco, female, medical, death benefit, and funding. So we're going to come back to our little chart over here. And we said that our annual amount is 36,480. And we're going to go to our riders. And we said our one-time contribution is 33,123. So we're going to divide that by 3. Divided by 3 is 11,000. 050. 3 years, 1 through 3. We're going to put a 20-year term on it. It'll update in a second. Okay. And we're going to take a look at the at a glance. So just real quick, 36,480 times 10 plus 33,123 is 397. So yeah, basically $400,000 at year 10. On the guaranteed side, we are at 418. Does anybody know why it was so much easier to get the second illustration to achieve the 10-year rule? Two things that anybody might have noticed. Okay. Sorry, go ahead.
I think paid up addition is stopping in 10th year. That's what I'm saying that.
Sorry, say that again.
Paid up addition.
The paid up additions rider, nothing is really changed about
Okay.
the way we're building the second
Mhm.
policy. The two things that are different are 1, she's female, and 2, she's younger. So those two conditions will always be less expensive to insure. So
You put in the same, so Kendra, you put in the same contribution, but it's just showing up different more for the female than it is for the male.
no, it's not the same contribution. Remember back over, can you see the little spreadsheet I have over here? We have, because of her income is higher, we've put a higher percentage of the death benefit onto her, which means that she needs a higher percentage of the contribution.
Oh, got you.
So yeah. So that's how we split it out, guys. It's always based on their income and their percentage of personal income to the household income. And that's how we determine how much of the contribution is going into each policy. Because remember, in the case of sudden death, we want to make sure that we are protecting the family. So the family, client 2, pay special values. Okay. So now we have a spreadsheet that has all of our values in it. So we have both illustrations so that we can see them all at once. So as a family, I'm just going to make some of these columns a little bit bigger. Okay. So as a family, their guaranteed death benefit in year 1 is $1.7 million. and their guaranteed cash value is 64,135. So we said that they wanted to retire at, I genuinely don't remember when we said they wanted to retire. In 18 years, that's right. We wanted to retire in year 18. Okay, so our guaranteed cash value is only 1.284, right? But over here, where's my life plan? Platinum. Over here, we said that our guaranteed growth was 1.8, right?
Yes, please.
So why is this different?
February, January.
That's pretty-
Sorry, say again.
Less premium.
It's not calculating the interest.
It is calculating the interest. Molly was a little bit closer with less premium. So in this spreadsheet, what have I not taken into account that they might be saving?
Age. I don't know.
So what I have not taken into account that they might be saving is all of this right here. So when their kids go to college, are they actually recapturing those dollars that they are not spending because their kid is not living in their house? All the money that they used to spend on soccer, on dance shoes, on electricity, that they're, because their kids aren't there. When their kid moves out to college, are they actually recapturing those dollars and saving them? Or is Parkinson's Law 2 happening and they disappear into the budget?
They disappear.
Right. So I don't know for a fact. Well, I mean, maybe they disappear, maybe they don't. But I don't know for a fact that they're actually going to do those things. So I don't include it in the illustration.
Mm.
If they choose to save that money, they have some space in there. And also for several years, that $10,000 per kid that they're saving is going directly into paying for the kid's college. Because they're saving $10,000 for their kid to not be living at home, and they're paying $10,000 on this end to send their kid to school. So they can now reallocate those dollars. And then when they are done paying for school, they can start saving those and start building up that cash value. But yes, so that is the answer, because every now and again, you will have a client that asks, you said $1.8 million. How come this doesn't say so? Okay, that's why, because we are not counting dollars that we don't have in the bank right now. Make sense?
Yeah.
Okay. So that being said, this little tool over here, we're sending our kid to college. I'm just going to make this the whole screen so you guys can see it. So we're sending our kid to college. We said that in year one, it's going to cost us $10,000. In year two, it's going to cost us $10,000. In year three, I think it was costing us $28,000. Year four, it's costing us $28,000. Let me make this bigger. Year five, it's costing us $18,000. In year six, it's costing us $18,000. So college. So the total that we're spending on school is $112,000 over a period of 6 years. But our guaranteed cash value column over here says that we have 385, but we're spending 112. So basically what this tool does is it subtracts out what we have spent from how much we had. So now we are here. And I always look at the guaranteed cash value for this because of two little factors. One, dividends are not technically guaranteed. Anecdotally, we can say that they are because they've never not been paid for 100 years. Through any crisis the world has gone through, a dividend has been paid every single year. But it's not technically by contract guaranteed. The other thing that we have not taken into account is the interest on the loan from borrowing from ourselves. So calculating that out, balancing it out, it's almost even. Erring on the side of you'll have more money than this. But that being said, that spent, this is what we have. And if they pay themselves back, more is the better. But we don't know when they're going to do that. We don't know if they're going to do that. If you're showing this tool to a client just so they can wrap their head around what you're telling them that they can do, you do need to legally tell them, depending on what state you're in, that this is not an illustration, but it is based on an illustration. You can tell them that it's based on an illustration, but it is not the illustration itself.
Right.
So, but it's basically simple math. You threw two illustrations into a spreadsheet and added every single cell to get this. It's simple math. Does that make sense?
Yeah.
Okay. So this tool I find is very useful when people are trying to do things like pay off a house.
Mhm.
And that house is going to cost, at that point, $175,000 to pay it off. You know, what is that going to do to your cash value? What is that going to do to other things that you have going on? Do you actually want to do that? Is that a productive use of your money at that time? You know, maybe you want to buy an investment property that will pay for itself and your mortgage, thus raising your income. So there are other options. I had wanted to get into the spending tool today as well. I don't think we're going to have enough time to do that any sort of justice. So I might push that out for another week. Does anybody have any questions?
I just have a question. How did you tie both spreadsheets together?
Oh, we dropped them in tab 1 and tab 2.
And then calculate them together?
And then the expenditures tab is, it has, if you actually look at the cells, it has all these lovely little sum functions.
Yeah.
I
Just
like
to
seeing
see how
big
you-
pictures.
Huh?
I like seeing big pictures. So going back and forth between, oh,
Oh,
well,
no,
this is your
right.
illustration and this is your illustration. And if we, you know, do some mental math, yet nobody has time for that.
No. I mean, I just didn't get how you put them together though.
Yep. It's a very simple sum function. Peter, I think I've sent you this spreadsheet before.
No, not this one.
All right.
Prior
Anybody-
ones, but I didn't
Anybody who
respond.
wants this spreadsheet, let me know. And I can send it to you. So don't play too much with the total page, because that will mess with the bottom line. You don't want to mess up the
Right.
the built-in okay, so Sal, send, you know, I'm gonna put my email in keywords at financial.com. Okay, so I just sent it to one person, not the class. Control copy. I'll just retype it. Financial.com. Okay, so that is my email address. Feel free to send me an email if anybody wants the spreadsheet. Let me know what I'm sending you, and I'll send it across. And they are working on upgrading the software. I highly recommend it. So hopefully within short order, we will be able to get all of these weekly trainings live on the software inside of it, and I'll be able to upload some of the tools that I've created as well to help people get access to those assets. But yeah, the software all by itself as it stands right now is a really very cool tool because it does all of the math for you. And next week, if anybody has something that they want to see that they'd like me to go over, that they have a financial concept that they'd like explained or what have you, send me an email. I am more than happy to design the trainings around what is important to you guys, what you don't understand, what you want to see. Yeah, so I'd be happy to go over that. Otherwise, next week, if I can go back to over here, we'll go into the spending tab, because you can actually, let's say that their desired monthly income, we'll call it $9,000. So let's say they had, yes, we want to see belongs to client starting age 68, 67, sure. Show 4%, save changes. This is basically how it works, that you can show income from varied income sources. Average annual income was $55,000, $95,000, 67, I think we said 67, save changes. Yeah, so we've got the Social Security, we've got the 401k and various income sources to produce their retirement. So then the question becomes, how much money do they actually need? That is a major question, and that is the, what is your desired monthly income? People have no idea. You're going to have to walk them through how to get to what they actually need to maintain their current lifestyle. So we'll go through that next week, unless anybody has another suggestion of what they'd like to see. So at this point, does anybody have any questions? I feel like I've been talking a lot. Okay. Great. So if nobody has any questions, we're coming up to the top of the hour. We've got a couple minutes left. I'm happy to adjourn early or happy to stay for a couple minutes to address any questions. Again, I highly recommend using the software. If you do not already have a subscription to it, you can go to lifeplan360.com, which I will put in the chat. lifeplan360.com to subscribe to the software, because as we've been going through everything that you've seen the last couple of weeks, all of these it's just inbuilt into the software. It's very easy to use. It gives you the what do I say and when do I say it type of conversational things. And beyond that, don't wait until you're 100% comfortable to get out there and do it. A client doesn't know precisely what you're supposed to say. All they know is what you do say. So just go out and do it. If you skip a step or like you're not comfortable beating down their advisor, and quite frankly, I don't like beating down somebody's advisor. If there's somebody that you really, really like, I'm not going to tell you that that person is terrible. But I'll tell you what other people have said about the 401k, the stock market, what have you. I'll ask questions like, is what you're doing now, is it guaranteed? Is it taxable? I'll ask the questions, but I'm not gonna like really say that your advisor is screwing you over. Like, I'm not my bag. That is not the way I run business. So yeah, just get out there and do it is really my advice. So, work with your strengths and don't be afraid to use the little helpful hints that come up. Like as we've seen before, like when I'm going through this stuff, I'll click on like Parkinson's Law #1. And if you need to read this verbatim, go for it. If you don't need to read it verbatim, still click on it. Your client likes to read it too, because then it creates validation in their head when they're reading something that you're also saying. So fun facts. Okay, so any other questions before we adjourn for the day? Okay, great. So it was great seeing. Oh, do I have everything? Do I have any questions in the chat that I should check?
Hey, Ken,
Yep.
real quick. There's that book in the platform that talks about the insurance. Do we
Money,
have the
Wealth, Life
PDF to
Insurance.
that book?
Yep, that is
Yeah.
that is under the resources tab. Let me show you where that is. So if I go back here, so is that under training?
Is this something we can
Resources.
share? Even though you don't have the
So it's available
soft-
in the software. So yeah, it's under training under the resources tab. It's right here, Money, Wealth, Life Insurance, and you can just download it. This is
Yeah,
something
okay.
that I send out to clients all the time.
Can you open that?
Yep,
Okay.
it's all right here. It even flips through like a book with the annoying page turning noise. Yep.
Okay.
Okay.
You said we can. You said we can download it.
Yep, you can download it. It's right in the software. Feel free to download it. Feel free to share it with clients. I send it to clients all the time. Honestly, I also keep copies of the book on my desk, which I would highly recommend getting a copy to have on your desk, simply for moments like this, when you are in a Zoom meeting with a client, you're like, actually, this great book that I have is, explains all of this stuff. I'd be happy to send you a PDF copy, but you have the tangible copy in your hand. And if you have not read the book, read it. Never send something to a client that you have not read and understand, because if they come back to you with questions, you don't want to get caught out. So,
Do you send it to? Do you send it on all your client cases? Do you send it to your client, or it's just based on your feel for their need to be educated that you send it to them on?
I usually send it to clients because in the process, I'll ask them what they know about life insurance. And if they are not overly familiar, or you'll get the Dave Ramsey people who are like, oh, it's so expensive. Okay, well, let me run down that scenario with you. Is it really expensive? And do the math on it. Do the math with them and show them the actual cost of term life versus whole life. And the fact, especially a whole life with us, because they will have an asset that they cannot outlive, that they can leverage cash value equal to or greater than the amount of money that they put into it. So how much is their death benefit costing them really? So it's, yeah, there's that approach. And yeah, so I use that quite regularly with clients. How can I access the PDF copy of the book that you refer to? So you get the, all of the resources and under the resources tab, go to lifeplan360.com, register for the subscription, and all of the resources are in there. Do most people prefer the PDF version of the book or the physical copy? I cannot tell you that. Personally, if I'm reading something, I much prefer to have a tangible book in front of me, as opposed to reading off a computer screen. This is going to sound terrible, but I would print it out if somebody sent it to me. But in terms of how I deal with my clients, I am licensed in about 12 states now. And yes, I'm from New England, which is very small, but you're still going pretty far afield. You're not going to be in a position to hand every single person a book, and shipping becomes expensive. So even the cost of the books, if you were to get them from like Amazon or whatever, unless you were physically handing it to somebody, I would just send them the PDF. Does that answer your question? I hope.
Yes, thank you.
Okay. Okay, so we are at the top of the hour. Is there any other last minute questions before we adjourn for the day? I am on your website. How do I download the book? Okay. Have you logged in? Okay, so if you're logged in, go to on the left-hand side, there should be like a black dashboard bar. There should be a icon that says training on it. It looks kind of like a dumbbell. So click on that. It's going to pop up a sub menu. You want resources. Okay, no, you're not logged in. You would need to log in. Yes, you should be able to, it should say something about subscription at the top on the right-hand side, very top of the page. It'll say something like register or sign in, log in, something like that. It's been a while since I've done it. Let me log out. Let me log out and then I'll be able to tell you exactly what it says. It says member login or need an account. Okay. If anybody needs anything else, please feel free to email me, but I do want to be mindful of people's time. So thank you all for coming. And again, my name is Kendra Rhodes, and let me know if you need anything. I'm more than happy to answer questions offline. And have a great weekend. I will see you all next week.
Bye-bye.
Thank you.
Bye.